Randy, you heard Steve's preview there. What are you going to be looking for in less than an hour when we see these minutes?
I think those are really the key issues, because I think, as I think I've said on this program before, the Fed's not going to quit until the labor market quits. And so my guess is you're going to have a lot of discussion about, well, why have these lags been so long? Why aren't we seeing the job market turn down yet? What is the potential for high wage demands to then keep core prices, the core indices on prices up, because it's core price indices are the ones that are much better predictors of where inflation is going. There's a lot of movement in energy prices or food prices. Those seem to be coming down. But if you look at the core numbers after stripping out the food and energy prices, those haven't been coming down. That has been kind of flattening out. And I think that's really going to be a key motivator for the Fed to say, yes, we need to keep going ahead, and I think the markets are right. They're going to go ahead with this next one, unless there's something cataclysmic with the job numbers on Friday.
But Randy, there's sort of a cognitive dissonance going on here, isn't there, with the Fed? Because you've got this dual mandate, right? They are responsible for making sure that employment is high and inflation is low. And in this case, you're looking for lower jobs numbers in order to put the brakes a little bit on increasing interest rates going forward and solving the inflation battle. How can the Fed get both of the things that it wants when they seem to be at odds with each other?
That's always the tough question, to get that balance right. Well, right now, the unemployment rate is below where they think the long-run average is. They have the long-run average in the low fours, and the unemployment rate is in the threes. So they could have the unemployment rate move up, and that's still consistent with their broad mandate to maximize employment growth. But it's consistent with low and stable inflation. And man, inflation has not been low and it's not been stable. So they're really missing so much on one of the two goals that they need to make that the priority. And that's what Jay Powell's been talking about for the last year. And that's why they've driven interest rates up at near record pace.
Steve, you want to jump in here too, right?
Yeah, I think it's well to remember the paper we talked about a couple weeks ago from former Fed Chair Ben Bernanke and IMF Chief Economist Olivier Blanchard. They had said that the labor was not a big part of the reason for inflation to this point. But they said that could be yet to come. So I was wanting to respond to what Randy was saying, which is very important, that we really haven't experienced wage push inflation, but it's the fear of it that I think is as other factors in inflation recede, it may be that we're left with some form of wage push inflation. And it's hard to divorce this conversation from some of the tension going on in the with unions and with employers right now. The unions, to my mind, act like they have a tight labor market behind them and that the employers have to negotiate here. So that's, I think, another sign of how tight the labor market is. And I would layer on top of that some of the high-frequency data that I've been looking at, which also seems to show that we still could be headed for a strong jobs report on Friday.
Yeah, Randy, react to that. I mean, you're a former Fed governor. You know, you've been in rooms where these kind of things are discussed. Is the fear of high wages still out there, or is that sort of a psychological thing that doesn't really exist in the real world?
Oh, no. Well, I mean, the wage demands come from people's expectations, and those are their beliefs about where things are and where things are going. I mean, part of it is the real wages, that is the inflation-adjusted wages, have been terrible over the last year or so. Inflation has been much higher than the wage growth. Nominal wage growth has been high compared to where it used to be, but inflation has been 3, 4, or 5 times what it used to be. So what may be happening is that people say, well, you know, I didn't quite get enough last year. And sure, inflation is coming down, but I got to make up for what I didn't get last year. And so even if inflation does come down from the 4 to 5% range that we're in down to, let's say, even 2 to 3%, they still may be asking for 4% wage increases. Well, that's going to mean it's going to be really difficult to get down to those 2 or 3% levels. You're probably going to be persisting in like the 3 to 4% range, because labor costs are such a large and important factor in overall costs, particularly in the services area, but even in manufacturing.